Thank you for giving me the opportunity to speak to you today. I'm very pleased that Bloomberg has decided to hold this Future of Finance event in Frankfurt for the first time. This decision highlights Frankfurt's growing importance as a financial hub in Europe and worldwide, a trend that goes well beyond the effects of Brexit and the transfer of business from London to the continent. I can imagine that the issue of Brexit has kept many of you busy in recent days and months. I can reassure you, for the next 20 minutes or so, you will not need to think about Brexit or even have to hear about it. However, Brexit emphasizes the urgency of the project which I will address and which is central to the Eurozone and the European Union as a whole. Today, I will be talking about the banking union. Ladies and gentlemen, let me be clear from the outset. We need to move forward with the banking union, and we need to move forward now. The necessity of deepening and completing the banking union is undisputed. Parliamentarians, finance ministers, supervisors, academics, and market participants easily agree in principle, though they are not prepared, as we learned. The reason for this is straightforward. Because it is in our best interest. It is in the interest of the European Union, and it is in the interest of each member state, including Germany. A banking union that is equipped with the right regulations, institutions, and procedures will enable us to overcome the still existing market fragmentation and let capital and liquidity flow to where it is most needed. It will strengthen the competitiveness of European banks and enhance the stability of our banking sector as a whole. It will improve the ability of the Eurozone to respond to macroeconomic shocks and weaken the sovereign bank nexus in Europe, which is still too strong. This banking union will benefit European businesses, investors, and depositors and protect European taxpayers. To make a long story short, a completed banking union will establish a common market for banking services, further strengthen our internal market and general welfare gains for the entire union. All this is common knowledge, and it can easily be confirmed by a brief look at the United States, where the alignment of laws and procedures and the centralization of competencies has created a huge and unified banking market, generated competitive advantages for US banks, and helped the US to reach a higher growth path. In Europe, we have taken major steps forward. We have created the single supervisory mechanism and the single resolution mechanism, and we are establishing the ESM as backstop to the single resolution fund. We have harmonized deposit insurance legislation and aligned rules on capital, liquidity, and bail-in. We have reached these sometimes difficult compromises because we were ready to set aside individual short-term concerns and to think and act European. On other major key issues, however, we are experiencing a standstill. Technical discussions on a European deposit insurance scheme have gone back and forth for many years. Progression on other issues seems impossible as long as the question of a European deposit insurance remains unresolved, and the inverse is true as well. General political willingness has been expressed by all parties, but these statements of political will too often failed to deliver practical results. We cannot afford the deadlock any longer. It affects the functioning of our internal market, and it affects the trust of EU citizens in our ability to solve problems, even those problems that we have fully acknowledged. It is time for a breakthrough. It is time to put together a package to complete the banking union. A fair and balanced banking union that enhances stability, competitiveness, and growth in the Eurozone and in the European Union. Today, I want to lay out what this package should look like. It consists of the following main elements: further enhancing our crisis management and supervisory regime, further risk reduction and better rules to avoid harmful arbitrage. And this package also includes a common European deposit insurance. Let me describe in more detail the elements which we should agree upon now and implement consistently. I will start with the enhancement of our supervisory regime and crisis management. Ladies and gentlemen, we need to further improve the institutional and regulatory setup in order to ensure the continuous review and management of risks in our banking sector. The SSM and SRM have proven their operability. However, the SRM applies to large, systemically important banks. Smaller banks in crisis are dealt with on the national level and under national rules, in particular national insolvency law. This can lead to situations in which smaller banks or their creditors are treated in a way that is inconsistent with the European resolution principles, for example, when unsecured creditors are protected that would have been bailed in under the SRM. At the same time, because national insolvency laws serve as point of reference for SRM resolution, differences in these national laws make the cross-border resolution of large banks more complicated and contentious. If we look at the situation in the United States, the strong position of the FDIC can teach us two lessons. First, instruments that have proven useful under the resolution framework for large banks should also be part of the harmonized deposit insurance toolbox for small banks under insolvency. This includes the establishment of a bridge bank or the transfer of deposits. Where necessary, these alternative deposit insurance measures can be financed by the relevant deposit insurance fund, as long as the strict least cost principle is applied. In other words, alternative deposit insurance measures need to be less costly for the deposit insurance fund than a payoff insured depositors. The SRB should play a significant role in decisions on these alternative measures. Second, given the frictions between European resolution regulation and national insolvency law that I just mentioned, we need to adopt genuinely European bank insolvency legislation. Another improvement of our supervisory system and crisis management tools has to do with the integration of cross-border banking groups. I'm talking specifically about the allocation of capital, liquidity, and bail-in buffers between parent companies and its subsidiaries. This issue has been discussed under the keywords ring fencing and home host, where host countries call for the protection of subsidiaries in times of crisis, whereas home countries support the free flow of capital and liquidity within a banking group. A forward-looking and equitable solution must take into account host country demand for fair burden sharing while allowing as much integration as possible. In my view, the right solution would be a combination of both. Maximum flexibility to efficiently allocate capital and liquidity within the banking union in normal times, and a clear allocation of capital and liquidity between parent companies and subsidiaries in times of crisis. This allocation would follow a mandatory waterfall payment scheme based on statutory provisions and a decision by the SSM and the SRB. In order to be fully effective, this new framework may require the harmonization of bank company law. One option would be to create a European legal form for banks or to refine the design of the European company. Ladies and gentlemen, a stable banking sector requires further risk reduction. This includes the consistent and sustainable reduction of non-performing loans as agreed in 2018. We have agreed on far-reaching rules such as the NPL prudential backstop, which will be implemented now. And it also means that we must further improve our policies and practices to combat money laundering and terrorist financing across the EU. The most contentious issue of risk reduction has so far been the regulatory treatment of sovereign risk. Still, neither risk weights nor large exposure limits apply to sovereign debt. We acknowledge that any reform to the treatment of sovereign debt holdings by banks needs to be carefully calibrated in order to avoid risks to financial stability. Nevertheless, in the wake of the financial and sovereign debt crisis, there is general agreement in principle. Sovereign bonds are not risk-free. Furthermore, a high exposure to a specific sovereign, often the bank's home country, also poses a risk to financial stability. The key words here are home bias or sovereign bank nexus. Any solution must take these aspects into account. The solution I propose is risk-based concentration charges and safe portfolios. The model of risk-based concentration charges combines three components. First, an allowance for sovereign debt of an individual country that would be exempt from capital requirements. Second, basic risk weights based on credit quality. And third, a concentration factor reflecting the concentration of a specific sovereign risk on the bank's balance sheet. This approach would create strong incentives to reduce home bias and diversify sovereign risk. A careful calibration and an adequate phase-in period would prevent excessive burdens on banks and avoid financial stability risks. Over time, banks in all countries would build up safe portfolios of sovereign bonds. This would achieve twofold benefits. It would enhance the stability of banks, and at the same time, it would help countries with weaker credit ratings. Ladies and gentlemen, in my view, a common European deposit insurance should be part of the banking union framework which I have described. We have discussed the Commission's EDIS proposal since 2015 with no agreement in sight. Interestingly, no member state has ruled out a European deposit insurance in principle. There is general agreement that the European scheme could counteract bank runs caused by a loss of confidence in national institutions and thus stabilize the financial system. However, many member states, including Germany, worry about creating wrong incentives by shifting liabilities from the national to the European level. I am convinced that a European deposit reinsurance system could reconcile the various concerns and cut the Gordian knot. This reinsurance system would be based on an intergovernmental agreement, and it would complement national deposit insurance schemes fully set up under the GSD with the European Deposit Insurance Fund. This deposit insurance fund would consist of different national compartments and be administered by the SRB. In case of a bank failure, a three-tier mechanism would apply. First, national DGS funds would be used according to the DGSD. Second, if national capacities have been exhausted, the Deposit Insurance Fund would provide limited additional liquidity through repayable loans. And third, in rare cases where additional financing is needed, the respective member state would step in, possibly supported by a regular ESM program. This European deposit reinsurance system would significantly enhance the resilience of national deposit insurance schemes, while at the same time ensuring that member states fulfill their national responsibilities. In a second and final phase, once all elements of the banking union have been fully implemented, a limited loss coverage component could be considered in addition to the repayable loan. A common European deposit insurance is seen by some as an instrument to promote a level playing field between banks in all EU member states. I share the objective of fair competition, and this brings me to my last point: the need to avoid harmful arbitrage in the banking union. One key factor that leads to the distortion of competition among member states is tax law. Germany, working together with France, is pushing for a common corporate tax base and a minimum effective taxation. Progress with the banking union must not lead to a situation where tax arrangements continue to distort competition. For this reason, we must ensure the uniform taxation of banks within the EU. This includes the uniform tax treatment of SRM levies, which is already stipulated in the SRM Intergovernmental Agreement. Ladies and gentlemen, to sum up, the completion of the banking union is a key project for enhancing stability, competitiveness and growth in the Eurozone and the European Union. It is in our common interest. I have outlined the measures that need to be taken. This is a comprehensive, fair and balanced package. We have proven that progress is possible when we adopt a European perspective and when we are ready to compromise. It is time to move forward now. Thank you.
Yeah, Mr. Scholz, I want to say thank you again, because it's one of these rare days over the last 10 years, I would say, that Germany actually has made a constructive proposal for the banking union in Europe. So far, Germany is really standing a bit on the brake. There haven't been concrete proposal. It was mostly that Germany took the position of saying no to whatever came from Brussels. So, and I would also even say that your proposal is fairly brave in the sense that it's breaking a taboo, and it's basically saying that Germany or Europe needs a deposit scheme. But this is as far as my gratitude probably goes. I also would like to look now a bit closer at the proposal and what it actually means for the European negotiations, the development, and also later on look for what it means for Germany. But starting also with why I think it's brave. It's brave because we have seen massive resistance across the board, across the parties, and particularly from the savings banks. So, and what you always hear is a deposit scheme will basically lead to German savers and at the end of the road, German taxpayers to pay the bill for bad managed banks in some other countries. What do you tell them?
It's an important question. It must be answered, but possibly it might be useful to explain you my view on the question. The first view I took was that we should understand the European Union more and more economically as similar to the United States. So if we understand how the complete model of a banking union in Europe should be developed, we must look at a big region and big state like the United States and understand how the banking union there is modeled, how the legislation is, how the supervision is. And it is a mistake just to go step by step without having a whole view on the picture of the United States, learning what we could use and learning what we will not use, to be clear. And the second is looking at the European Union means to use a space shuttle and look from space down to Europe, and how this all will work together if you have a view which is not just from inside. And if you do this, you come to very similar results as the ones I propose here, because then the question is not what you ask for in a special moment for your own company, for your own country. You ask, how should the European Union organize the banking sector for having the best efficiency and the best effects on growth in our continent? And understanding this, the first sentence is a banking union produces growth. If we don't believe that, we shouldn't continue to act on this field. If there is no sense, which means more jobs, more more successful companies, more growth in our European Union. There is no sense for doing this. So I learned in many talks I had with many scientists, many people from the business, that anyone agrees that a banking union will produce more growth and that anyone will benefit from it. Understanding this, we must just say, yes, there is no model of a banking union that you could draw, which does not include a deposit insurance scheme. On the other hand, all the necessities must be written down. What are the circumstances? What are the conditions? But it is not to avoid the insurance scheme as part of the ready European banking union, but it is just a debate about how to do it. And then there is enough opportunity to save anyone from just paying for others with no use for yourself.
Yes. But coming back also to my question, I mean, we do know that there is also a lot of reservation with the coalition partner. And there is now the question, I'm getting this from Brussels, but from Berlin colleagues as well, has this actually been agreed within the government? And how are the chances that Germany, that you, at the end of this year, are actually going to agree on a roadmap which outlines somehow a deposit scheme?
We have the need to start with the debate now. We have a new commission. There is a president-elect who already also says that the banking union is one of the key priorities of the new commission. This is so with the parliament. So it would be a big mistake just to continue with what we have now, in the end saying nothing, but yes, we will start the debate later. And this is why it's necessary to make a proposal which is then the starting point for a discussion. I think there will be many people, not just in Germany, that in the first moment react as they always did. The ones saying we don't want to have something like a banking union if not the following 5 conditions are solved before. And the others who ask for a European deposit insurance scheme without doing anything else. This is what we have. And we have to get out of this situation. And this means that we have to think, what is the way to get out? And my answer is, the way to get out is not to stick to single questions, to the one or the other point, but to draw the scenario of the end game in the end of this banking union, and then come back to the steps which you have to take for getting there, but not discussing about steps without knowing where you want to go to.
Yes. And when we look at the steps you're proposing, let's go a bit deeper into the proposal, then one sees, and the critics say, that while maybe an agreement might have become easier, the conditions for getting there have been piling up. You are asking now for an insolvency regime in Europe, which we can imagine it might take not 10 years, it might take 30 years. If this is a precondition for a deposit scheme to be implemented, on what time horizon do you see this ever happening?
I think we could have. The main proposal is, the first thing is we have to understand, without an insolvency regime for banks, it's not about working with non-performing loans. This is another question of insolvency. It's the insolvency regime in the question of banks themselves. We have to understand that it's necessary. It will not work with the system we have today. Then it makes no sense to discuss about the banking union. But it would be a too big task to say we want to have a harmonized insolvency legislation about all the businesses in Europe. But sticking to the business that is really urgently pressing for having something like a banking union, is something that could work very fast. So my proposal is, if we agree that this is needed, sticking to the question of banks and to financial institutions, it might be very much easier, and it may be possible to reach that in a very short time of just a few years and not of 10 years or so. It may happen very fast.
Mm-hmm.
But you should understand, you cannot dissolve a pan-European bank with involved 10 or 15 different insolvency regimes, treating all the different the situation in any country different. Then you cannot have an all-European banking system. It does not work.
Yes, but you're talking, the proposal is now towards developing the banking union, towards the deposit insurance scheme. There's also a lot of critics who say basically the existing resolution system just doesn't work sufficiently. And it's basically a proposal the German government had been insisting on, that there is a bail-in in order to protect that taxpayers will be the last resort. But we have seen in practice that the resolution system hasn't been implemented. Italy avoided it and sort of used a loophole to do a national solution and use taxpayers' money. And only Banco Popular in Spain was resolved, but there the bailout regime didn't apply either. And if you look to Germany, also in Germany, a resolution hasn't really taken hold. So you suggest also that the resolution regime should be developed. But in what way? Would you tackle the bail-in issue again? Or do you say, as it sounds, that we have to change the surveillance?
We have a more or less good system looking at the SRB and this SRM. This is a good system working. But it's just for 280 banks or so. They are the most important, yes. But if you look at the whole banking union, you cannot have completely different systems looking at the other banks. And if you look at the United States, which I proposed to do in the beginning of our talk, you will see that the FDIC has a lot of competencies in this question to do something, not being always the relevant player, but always being able to intervene. And this would help to have a situation which is the same all over in Europe. And I think this must be part of a banking union.
And you also addressed the issue of ring fencing. Basically, banks being able to move money from home to host banks. You have in the past been stressing the need for Germany to be a home country. With this reform, do you think doesn't Germany need to be a home country anymore? Which basically means that in a merger situation, the headquarters doesn't need to be in Germany.
I would prefer it.
So yes. So
I trust in the banks that they are competitive enough to draw a home. That Germany will continue to be a home country.
Yes. But this is exactly the key of the argument why banking union is needed in order to allow more transaction European-wide and also to bring down protectionist barriers, national protectionist barriers, also to allow mergers. So
no, this is part of the game, but not the main question. This is absolutely not true. And if we just think about mergers, we will be not successful with the whole question. It is a part that may happen. But the main question is to have better chances to use the whole European market for your activities, which is not the case today because of all the ring fencing. And to start with the debate, there are good reasons for having this from the perspective especially of the host countries, and there are a lot of them within the European Union and the Euro countries, zone countries. And but then you have, if you understand there is a need, it will be a better use of capital, it will be a better chance for growth in the continent, there will be less risks for taxpayers because there is private risk sharing attending, then you have to understand what are the needs to make this feasible without disobeying the needs of a lot of countries and their economy. And this is what I did.
You mentioned the taxpayers' money. I mean, one of the key motives of this reform is, and has been since the financial crisis, to avoid that the taxpayer is being, again, drawn to pay for failures in the banking system. A question I'm sometimes regularly on a weekly basis get, at the moment not so often, fortunately, is whether the German government would, considering economy is going down, the banking union isn't yet finished, and we have still to wait a few years until all the systems are...
Not too many. I think this is not a question of 10 or 15 years. And we were very successful in the last 2 years to reach a lot of progress which no one expected before. I just discussed about the ESM reform, which we are now finishing. This was a very strong question. We worked on banking union and capital market union with a lot of regulations that came into the light and that were born, which no one expected that they will be possible 2 years ago. So if you are thinking about the questions and the needs, if you are understanding your task, if the politicians are prepared, then it is possible to get somewhere.
But considering the flaws of the banking union and of the internal market, which are addressed also in your paper, and the fact that we are nearing a difficult time where we all don't know where it's going to end, the question is this architecture sufficient to rescue a big bank, or would the nation state still have to jump in, and would the German government, given the resistance to use taxpayer money, jump in and actually rescue?
If I get you right, I would say yes. If we have a very good model, a system with SRB, SRM, and SRF, and we are now building a backstop with the ESM. And this is, I discussed it with many people, really a very strong capacity which we have together. We will be able to fight any big problem with a big bank in Europe. And we are much more prepared than we were 10 years ago.
Because I know a lot of people, and you just have to open the newspaper. There's a huge concern how the economic downturn will impact the German banking industry, but the European banking industry altogether. And on top of all of the economic and possible fallouts, are the negative interest rates, obviously. The US, and the banks stress this all the time, the US have this competitive advantage that they have positive interest rates. You have been speaking out critically of banks loading off this negative interest rates basically to the normal saver. But what are banks supposed to do? Or should maybe the ECB reconsider its policy and maybe adopt more the Federal Reserve policy?
Anyone should be prepared for a situation with low interest rates, as we have it worldwide. And nearly anyone in this room, and many people I met in Washington when the IMF came together, are discussing about the question, what will happen the next time? And nearly anyone is absolutely sure that higher interest rates will be not the perspective which we will have in the world in the next years. So it is necessary to prepare for that situation. This is a business question, a question of a good management and about thinking what the bank should do to be economically successful in an ecosystem and an environment that is like this. And this has much more, it is not just caused by central banks. It is a part of the question. It is a much more important question, which has to do a lot with the development of our economic system today. There's a lot of money looking for investment, and they are just all looking for the same chances. So possibly if they broaden their scope, if there is more investment in questions that are necessary to be done for the people, for the economies, possibly there will be better interest rates. But on the other hand, you have to do something and have to find other questions to earn money, other businesses to earn money, as just working with the savings.
Yes, I have a follow-up question from the audience, from Bank of China, Haining Shang. Who would like to know really what you think about the impact of negative interest rates for the economy, not for the banking sector? How do you judge this?
As anyone knows, I think it should be avoided that the banks are just giving negative interest rates for their savers. And if you look at the regulatory framework we are working in, if you look at all the agreements they have with their clients, it would be not very easy to implement something like this. And my view is that we have a question which is the relation between the central banks and the banks, but that it should be treated carefully if you look at the private sector.
Coming to another challenge which the German and European banking market is facing is digitalization. We do see that European competitors, starting from Santander, BNP Paribas and ING, they are all well ahead of the curve in terms of digitalization in comparison to German banks. What can politics do, and what should the German banking sector do? Is this possible to catch up for the German industry? Is this possible, as one sometimes hears, that a European platform is really created to allow sort of a level playing field? Or is the only way German banks catch up to digitalization a merger?
I think you are obsessed with this question.
Well,
but this might be your problem. So, and I think we have to do a lot in our countries, in our economies, to be on the front runners in digitalization. If you want to profit from these new opportunities, you must be one of the front runners. Otherwise, you will not profit it, but just suffer. And so it's absolutely clear that anyone has to do anything which is feasible in this question. And this is also due to the private companies, the banking sector in Germany and other places, that they try to be at the best stage they could reach. And this is a management task. There is no public activity that we can do in this case. We just can ask them to be efficient, and the supervisory institutions have to look at the situation, because this has something to do with their competitiveness, with their chances to be economically successful. But in the end, it is a task that is well understood by the management of the banks, as far as I know, and they are doing a lot to be at the right level as all their competitors. The second is about a European platform for paying. I think we need something like this, which is of the size as the platforms we know from other countries like the United States or China. So there is something to happen to get this, to get something which is a European or two big European payment systems that are economically successful. So this is also a business question, but it is also a question of European business and industry policy in the question of financial services. And if you look at some of the unicorns in the fintech sector, you will see that there are some successful companies coming also from Germany and other European countries. So there is there are a lot of advantages that could be used. And so I think anyone has to do its task, but we have to be successful also in the question of paying systems. And just to mention this, and we should avoid that someone is building a private international currency, as this was the attempt with Libra. You know that I was very strict, and I am very strict in this question. This makes no sense. But on the other hand, it is a strong sign that it is not okay not to do better investments, because we have to have better paying systems in our countries and better cross-border payings, which are cheaper and faster and more comfortable to the private customers, but also to the corporates.
And I would like to ask the final question on a broader theme, which is not necessarily directed to the banking market, but which has also come here as a question of the audience, is basically considering the economic downturn and monetary policy may be coming to an end. There are calls from Draghi and analysts and investors basically for Germany to do more in terms of investment, but even to actually launch a stimulus program, which would help to stabilize not only Germany, but Europe. So what is Germany's answer to this?
So it is not a new call.
Definitely not.
Many people are asking us for doing so, but if you look at all the words of the very prominent persons all over the world discussing these questions, you may have realized that there is a certain change. They start their request with the words, Germany is doing a very expensive financial policy. This is what they haven't done 2 or 3 years before. So they accept that we already do a lot. We have an expansionary financial policy. If you look at the figure of public investment, it is now on the highest level. We had it forever. We increased it with a government decision, which we took 2 or 3 weeks ago, in saying that we will invest more due to environment questions. So altogether, it will be nearly 600 billion euros in the next 10 years, which is quite a lot, and will have an effect on the economy, as it already has, as anyone accepts what we did in the last years. And the same is with with the reliefs we made feasible for low and middle income taxpayers. The same is with our very expansionary investments in research and development, in education, in the infrastructure, and in helping, for instance, families with their children, increasing the money we give to the families for having a better family life. And all this together is very expansionary. The good message is, if the lower growth is not becoming better, what any one of us is expecting will happen, we have all the abilities to act if there is really a crisis, but there is not a crisis which we see today, and it is not something we expect.
But I have to ask this question because I'm getting this question constantly. But what constitutes such a crisis? When would the government act? And how does the constitutional debt brake play into this? Is there sufficient leeway for the government really to take early on action to prevent a deepening downturn?
If you look at the German economy, you will see that we have a very high number of people employed, the highest we had for decades. I think it is It's the highest figure of employed people in Germany in history. We have still a lot of companies that are looking for labor. We have in the construction site industries that are not able to serve the demand. So this is not a crisis, obviously not. The only question which we have to deal with is that the growth rate worldwide is slowing down, and this has a lot to do with trade conflicts and losing confidence in the business sector in many countries in the world. They are just waiting, and they are waiting and waiting and waiting for these trade conflicts to be solved. But if these man-made problems are solved, which is easy because it's just people that have to agree, this will have a very good effect on the economy, and we will have a better growth than we expect today.